So what exactly does Goldman Sachs sell? It's not your typical bank. You can't just walk in and open a checking account. Yet for more than 150 years, Goldman has been one of the most powerful financial institutions in the world. On any given day, the firm might advise a government on raising capital, guide a CEO through a merger, and move billions in stocks, bonds, currencies, or commodities, often before the closing bell. To outsiders, it feels almost contradictory. How can one firm be a trusted advisor and a giant trading house and still convince clients their interests come first? And why do they so often walk out of market crashes stronger than they walked in? That's the question driving this breakdown. In today's video, we'll discover the brilliant business model that stabilizes Goldman's earnings and the three big bets shaping its next decade. Goldman doesn't sell loans the way a Main Street bank does. It sells access to capital and markets, the ability to get big things done, and the confidence that complex transactions will clear. Here's how that translates into today's structure. First, global banking and markets, which is the combined investment bank and trading arm. Investment banking is where Goldman advises governments and corporations on raising money, buying competitors, or restructuring debt. Think mergers, IPOs, and bond sales. One deal alone can bring in hundreds of millions in fees. This works great in bull markets, but when the economy slows, this business dries up fast. This part of the business is also responsible for trading activities. Goldman makes markets in stocks, bonds, currencies, and commodities. They charge spreads and fees, and they thrive when markets are moving and volatile. When things are quiet, revenue shrinks. It's unpredictable, but often the single biggest source of income. Second, asset and wealth management. Goldman manages over $3 trillion for institutions and wealthy clients. Unlike deal making or trading, this side brings in steady, recurring fees. It may not make headlines, but it's reliable and central to Goldman's long-term strategy. Third, platform solutions. You might remember Marcus or the Apple Card. This part of the business is Goldman's experiment in retail banking, but after scaling it back, this segment is now tiny. It adds a little revenue and probably won't shape the company's future. On average, the revenues break down like this. About 65% from global banking and markets, 30% from asset and wealth management, and just 5% from platform solutions. Altogether, these businesses balance each other out. When banking slows, trading may surge, and when trading falls, wealth management keeps things steady. If you're new around here, make sure to subscribe and tap the bell so you don't miss the rest of the series. And drop a like if you're finding this interesting so far. Goldman Sachs pulls in between $45 and $60 billion a year, depending on how the markets are moving. In 2024, revenue landed at over $53 billion. Strong years push results towards the high end, while slower deal making drags them down. Breaking down the revenue, global banking and markets, which generated about $35 billion in 2024, a number that grows when markets are volatile and deal making is strong. Asset and wealth management added roughly $16 billion, providing steadier, fee-driven income that smooths out the cycle. And platform solutions contributed about $2.5 billion, the smallest slice with thinner margins. From an expenses point of view, about a third of revenue, more than $15 billion, goes straight into salaries and bonuses. That culture of massive paychecks is costly, but it helps Goldman Sachs attract and keep top talent, even with the famously long hours. Profits, meanwhile, remain strong. In boom years, Goldman earns 8 to 20 billion in net income, and even in weaker markets, it still makes 6 to 8 billion. In 2024, profits came around 13 billion, a sign of how resilient the model is. For investors, Goldman also has a clear playbook. It pays dividends, but it leans heavily on stock buybacks to boost earnings per share. All in all, Goldman doesn't really look like a traditional bank. It's closer to a mix of a professional services firm, a hedge fund, and an asset manager powered by talent that costs billions every single year. But how does Goldman's performance stack against peers? Goldman Sachs isn't battling your neighborhood bank. Its rivals are the global heavyweights: JP Morgan Chase, Morgan Stanley, Bank of America, and a few European giants like Barclays, Deutsche Bank, and BNP Paribas. Among them, JP Morgan is the giant. It brings over $160 billion a year thanks to its consumer banking and lending arms, which give it the stability but also make it less focused than Goldman. Morgan Stanley, on the other hand, has gone all in on asset and wealth management. It now oversees more than $5 trillion, making it more of an asset manager's bank, while Goldman still leans into trading. Bank of America sits in the middle, strong in lending and competitive investment banking through Merrill Lynch, but not as specialized. And then there are the fintechs, Stripe, Robinhood, Revolut. They're not replacing Goldman in mergers or billion-dollar trades, but they are changing how money moves. Goldman tried dipping into the world with Marcus and the Apple Card, but after scaling those back, it's clear the firm is refocusing on big institutional clients. Even with all this competition, Goldman consistently ranks in the top 3 for global investment banking fees and is a powerhouse in trading both fixed income and equities. That so-called Goldman seal on a complex deal still carries unmatched weight. But the challenges are real. Regulations have chipped away at old advantages, technology is squeezing the margins, and faster, more agile competitors are changing expectations. To stay on top, Goldman has to protect its reputation for elite execution while proving it can still adapt to a much tougher, faster market. Out of all the risks, regulation is the most obvious. After the 2008 crisis, rules tightened capital market requirements and cut back on the kind of risk-taking that used to boost Goldman's profits. More crackdowns from Washington or Brussels could squeeze the business again. Reputation is another. Goldman has been called both brilliant and dangerous. Any scandal around trading, conflict of interest, or its internal culture could hit the trust that's critical for winning advisory and asset management clients. Market cycles are a consistent challenge too. Goldman's revenue depends heavily on deal making and trading volumes. When IPOs dry up, mergers slow, or markets calm down, incomes fall fast. Asset management helps cushion the blow, but not completely. And then there's talent and culture. Goldman has always been a magnet for top performers, but it's also known for burnouts. Younger professionals today want balance and purpose, and they have options, from fintech startups to tech giants to private equity firms. If Goldman loses its edge in attracting talent, it risks losing one of its greatest advantages. Tech disruption is another force reshaping the game. Electronic trading and fintech platforms are squeezing the margins, while AI is challenging risk management and even deal advisory. Goldman invests heavily to stay ahead, but if speed and data start to matter more than prestige, its premium brand could fade. And finally, geopolitics. Goldman operates globally, which means it's exposed to currency swings, sanctions, and political instability. Conflicts and flare-ups don't just move markets, they can stall deals and trigger new oversight overnight. Goldman Sachs knows that tomorrow's Wall Street won't look like the one it used to dominate. Its future rests on 3 big bets. The first is scaling asset and wealth management. Goldman already manages about $3 trillion, but the goal is to increase that and close the gap with Morgan Stanley's $5 trillion. Wealth management fees may not have the excitement of trading or IPOs, but they're steady, recurring, and exactly the kind of income investors love. If Goldman pulls it off, it'll start to look less like a trading powerhouse and more like an asset manager with an investment banking arm attached. The second bet is technology and trading efficiency. Trading will always matter, but it's changing fast. Algorithms and AI are taking over. Goldman is pouring money into electronic platforms, automation, and ultra-fast systems to keep margins alive as trading becomes more commoditized. Scale and sophistication are how it stays competitive. And the third bet is a retreat from consumer banking. Projects like Marcus and the Apple Card turn out to be expensive distractions. Goldman is pulling back, keeping only selective partnerships. The takeaway is clear, its edge isn't mainstream banking, it's global capital markets. These moves point to a leaner Goldman, one that's less tied to the boom and bust cycles of trading and more anchored by fee income, still dominant investment banking, and willing to walk away from ventures that don't fit. The Goldman of the future looks like a hybrid, part tech-enabled trading firm, and still one of the most elite advisors in the world. Less adventurous than before, but maybe even more formidable. Thanks for watching this episode of S&P 500 in 500 seconds. Tap like and subscribe now that you're first in line for our next breakdown of Delta Airlines. It's dropping next week.